Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Hi, everyone. This is Yelena Levine from the ISC. Thank you for joining us this afternoon. We are very pleased to have with us again John Jagerson, a renowned author and Forex trader, as well as founder and contributor to learningmarkets.com. He's going to be presenting on hedging with limited risk using FX options. John has worked in the capital markets and private equity for most of his career, including investing, writing, money management, and was vice president of content for InvestTools. John funded his first private placement in 1998. His experience in Forex began as an owner of an import-export firm and quickly became a major focus for risk control and profit opportunities. His book, Profiting with Forex, was recently published by McGraw-Hill. He has been a featured profile on Business Week Stock Trader newsletter and has been published several times in numerous online and offline periodicals. He is actively involved in managing his own stock, options, futures, and Forex portfolio. I'm going to turn it over to John.
Thanks, Eleni. Everything coming through okay? Can you hear me all right?
Yes.
Okay, great. So to get started, I wanted to provide a little bit of an introduction. I think that this is a relevant discussion today in hedging with limited risk using FX options, and of course that implies a few things. It is possible, of course, to enter a trade with a known risk amount or a limited risk amount using options. Including FX options, obviously, and it can provide some advantages that we might not otherwise be able to get access to either through a traditional spot market, so working with a Forex dealer or something like that. And FX options, of course, provide some opportunity for traditional options traders to get access to the Forex market. It's kind of a blending of two, I think, very dynamic markets, or an investing product within a very dynamic market. When I say hedging, though, I want to qualify that just a little bit. So typically, when we think about hedging, we think about a couple of things. Either, taking advantage of an unknown event in the market that we're fearful of, something that perhaps we're long equities. Could we apply a trade that's going to be provide us some protection against that uncertainty, or if we're concerned about something damaging our long equity position, our long stock position, and there are definitely ways to do that in the Forex, but the argument that I would make for integrating a Forex trade or a currency options trade in that kind of position versus, let's say, a protective put on equities themselves or something like that, is that you're able to introduce a little bit of asset class diversification, which is in a way a hedge in and of itself. So when we look at a Forex option trade that looks promising, it provides us a little bit of exposure, not only to protect us against something moving against our other positions and other asset classes, but it provides exposure to that asset class specifically, and that in turn, we can get a little bit of a benefit from just value of diversification in general. These markets do tend to kind of move together or inverse to each other in certain ways, but that relationship isn't perfect. And so it can, sometimes we can have a winner in both markets, even if we were trying to quote-unquote hedge ourselves by using the Forex option. And the reverse is also true, so it's definitely something that we have to kind of balance and position size correctly and appropriately for the kind of risk we're willing to take. Okay, so I'm going to share, I like to primarily just jump onto the charts. So I'm going to share my charting application, and we can start to walk through some of the things that we're some of the things that I would be thinking about in this market as a way to take advantage of what's going on out there. Well, why don't we jump into this? So the chart that I'm looking at right now, this is YUK, and YUK it's essentially the index chart that the Forex options are based on for the dollar-yen exchange rate. And so the reading today that we have right now, the market closed at 90.19 yen to the dollar. And the yen's an interesting, the dollar-yen is a very interesting currency pair because it has some interesting correlations with the market in general, or with equities in general is what I mean to say. When traders have a lot of uncertainty in the market, or when we're expecting a consolidation or a bit of a pullback, and traders start to offset more aggressive positions like equities in favor of safer positions like treasuries or something like that, like what we're seeing right now in the market, they tend to get out of riskier trades in general, not just equities. One of the currencies that kind of gets caught up in that particular move from more aggressive trades to less aggressive trades is the yen, because it's used in things like the carry trade and such, and it's used to fund some more aggressive strategies. So sometimes we see this, and there are obviously a number of other factors at play that cause the yen to work to trend along with equities, at least in the short term. But that's one of them, one of the factors there. And so what we see is that when the market started topping out, the equity market started topping out in April and the very first part of May, we can see that the yen actually started or the dollar started kind of topping out against the yen. It's interesting that as trades get as traders get a little bit more risk averse, they actually start demanding more yen. And oftentimes what that's being driven by is some short yen covering. So it's a bit like a short squeeze, that we're familiar with in the equity market, where a lot of short traders have to exit their position all at the same time, and so they'll get out of their long positions, and that drives the price up. Well, it's very similar here with the yen. When YUK is dropping, that means that the yen's actually getting stronger, meaning it's requiring fewer yen to buy a dollar. And so we could approach this particular opportunity in a couple of different ways. Let's say, for example, I'm gonna look at another chart here real fast. Chart of SPY. This is, of course, the ETF that tracks the S&P 500. And when the market hit, a lot of people were forecasting between 120 to 122 as a potential profit target during the last rally. And it turned out that, and this is one of these cases where a lot of those forecasts turned out to be pretty accurate. And as the market started to consolidate up at this level, we had the ability to do a couple of things. So one is we could exit those long positions on equities, not knowing beforehand, of course, that the market's reversal would be very, very strong and robust like it has been. But we could leave that long position alone and try to take advantage of some potential adjustments in the market with Forex options, which brings us back to YUK.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.